Hey, good morning, everybody, and welcome to this Tuesday, February 6th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for a new trading day ahead. Yesterday, kind of a ho-hum kind of a session, definitely down a little bit, but in the midst of another nice uptrend, recently setting some new all-time highs. So last few days have been pretty good. It's been I guess 3 or 4 days now since I've been on here doing a show, but lots transpired. Of course, we had the Fed last week, which I did talk about a little bit on Thursday, but we've continued to get some Fed speak out over the past few days. I think that's kind of spooking the market. We're seeing the 10-year Treasury yield move up a little bit higher. Friday, we had a non-farm payrolls report that was well ahead of expectations. And not only that, and of course, that was for the month of January, but they also revised the November and December reports higher as well. So it was a very, very strong report on Friday, and with rates still being low. And of course, the Fed talked about and said, we're really not worried about the jobs number as long as we don't have inflationary pressures. And that's really what we have right now. We have a market or at least an economy that's been very resilient, to say the least, going through a number of rate hikes, aggressive rate hikes, and continuing to show strength, which I think is a very, very good sign about the overall economy and the strength of the economy to withstand all of those rate hikes and so forth. And so now we're kind of left with, where do we go from here? We're sitting at all-time highs. Is this the last hurrah? Is this still part of an ongoing secular bull market? I think most of you know what my answer to that is. It's the latter. I believe this is part of a secular bull market that will continue going higher, although we'll have bumps along the way. We always do. And sometimes I'll get some negative feedback from time to time saying, hey, you say you're bullish, but then you also say you're cautious. How can you be both? Well, you can be both. Sometimes I think we're in a runaway move, and I'll post or I'll talk about the fact that I think the market's set up or poised for a significant rally. And other times I'll say, well, we got some signals that we need to be a little careful in the near term. Doesn't mean I'm bearish. You can go back the last 5 years. I don't know if you're going to find anything where I said I was bearish other than at the beginning of 2022 when we went into the cyclical bear market. Other than that, I've been pretty much bullish and just trying to navigate some bumps along the road. Some of those bumps being a little bigger than others, of course. But no, I remain very bullish. I love overall. I think the Fed policy is conducive to higher prices in the market, and that's realizing that we're probably going to be looking at rate cuts down the road. Last week, I do think the Fed Chief Powell threw us a curveball. Of course, that's what he loves to do. He doesn't really throw fastballs. He likes to throw curveballs, screwballs, anything off speed that's hard to hit. But 2 months ago, or not this past meeting last week, but the meeting before, he talked about how there were going to be more rate cuts than what was expected. The very next month, he comes out and says the rate cuts probably aren't going to be as many as people expect. And it's not likely not coming in March. I mean, those are his words, 2 months, month apart from each other. So I think the big problem with the Fed and with the markets is that I don't think the markets can always read exactly what Powell means. And I'm personally, I'm frustrated with the Fed. I don't understand what they mean half the time either. Talking 1 month about, more rate cuts, stepping up the number of rate cuts, and next month saying, well, we may not cut as often as you might think. I mean, it started a long time ago under probably, I guess, Bernanke and then with Yellen, but they've been trying to be transparent. And I think the Fed chief's trying to be transparent now, Powell, but I just don't think he quite knows how. I don't know. I don't get it, but I could go on and on about that. I'm not a big fan of this current Fed regime, but it is what it is. We have to deal with it. So I think what's going to happen is rates are going to come down. Inflation's going to keep moderating down back into the target range for the Fed, and the stock market's going to go higher. That's my belief. It's been my belief. Talked about the bottom almost 2 years ago now. It was back in June of 2022. Thought the worst was behind us back then. I've been proven correct. And I don't believe that we're going to have a significant decline in 2024. Could we have a 5% pullback at some point? Absolutely. Could we have a 10% correction? I'm saying it's less than 50-50, and I'm talking about all of 2024. I don't know that we'll see a 10% correction. If we do, my guess is it's over the summer months. Probably as we get closer to the election and things just start to maybe look a little bit more uncertain. Market doesn't like that. But I still see the market going higher, and we'll see what happens. Anyway, let's move on and take a look at what happened yesterday. And first, the Dow Jones Industrial Average finishing down 274 points. We do still have negative divergences, by the way. I want to keep mentioning that because, again, a lot of folks, when they see a negative divergence, they want to act on it right away. I don't think that is the best way to approach a negative divergence. I think you need to let it play out. You need to let this rally play out. Almost any time you have a rally in the market, the PPO goes above the center line. When you pull back, a normal pullback, and when you first make the next breakout, if you go back and you look at the chart, when you first make the breakout, you almost always have a negative divergence. It's just the way the market works. I mean, when you go up and then you start to pull back, you're going to see that moving averages start to get a little bit closer together. When you're going straight up every day, short-term moving average goes up, long-term moving average goes up, but it's moving up less. So you get that increased distance between your two moving averages. That's what results in the PPO continuing to go higher, because all it is, the PPO is the distance between whatever two moving averages you decide. The default is the 12 and 26 period. And then once you have a pullback, that starts to turn that 12-day moving average, if it's a daily chart, quicker than the 26. So the 12-day starts to roll over and the 26 still keeps going higher, and you're going to get the PPO to fall. When you first turn back to the upside, chances are the 12-day will start to turn up, but the distance between the two won't be as big as it was before, and therefore you have a negative divergence. That's the way almost every breakout works. So if you're one to just jump right in on the first sign of a negative divergence, you're probably just a little bit premature with that call. Instead, you want to let that breakout go. How far is the rally going to go? You don't know when we first break out. Many breakouts are the start of another series of advances, and your PPO goes back up to new highs. So that's kind of what I'm working at. I recognize the negative divergences there, which is why I say we've got to be a little cautious, because we can turn at any time for a pullback to bring the PPO back down toward the center line. But it doesn't mean that we're going to have a bear market, which would be bearish, obviously. I'm not bearish. I don't see a bear market. So I just want to clarify that. That's one of the reasons why I think you have to be somewhat cautious, because you got a technical signal, one that works quite often, that is telling you to be careful. It's pretty much that simple. If you look at the weekly charts, a lot of those weekly charts look fantastic in terms of the PPO. So this daily negative divergence is only a short-term potential warning sign anyway. Maybe 1 week, couple weeks, something like that, if we were to pull back just for a period of time to unwind that daily PPO. Many times that little pullback on the daily chart will maybe also result in a 20-week EMA test on the weekly chart, and which is fine. You know, right off normally the rising 20-week EMA test is a great spot to enter. So anyway, just wanted to kind of clarify that for any of you that are new today. Certainly appreciate you stopping by, but I like to go over some of the things that are important to me often, because I know we have new folks that come on the show from time to time. Anyhow, Dow Jones, you can see down 274. S&P 500 down 16, so it was down about 1/3 of 1%. NASDAQ down a little bit less, only 30 points. That was under 0.2 of 1%. Mid caps, small caps continue to remain under pressure. Mid caps dropping 1.1%. Small caps, the IWM, which tracks the small cap Russell 2000, falling a little bit more than 1.25% yesterday. Transports down about 0.75%. Moving on to the sectors, you can see healthcare leading yesterday, up about 1/3 of 1%. Technology, the only other area in positive territory, gaining almost 1/4 of 1%. And then finally, materials leading to the downside, dropping 2.5%, a pretty big drop. And you can see on the chart, this is not a pretty setup on materials. I've been talking a while about materials and energy. I think you got to really be careful with those. I believe we've still got the dollar in an uptrend, which puts a relative, it puts relative pressure on materials and energy. So normally when the dollar is rising, those two groups tend to underperform the S&P 500. When the dollar is falling, the opposite occurs. A lot of times we see strength, relative strength in materials and energy. But I think with that strong jobs report last week, the fact that the Fed, feels pretty solid about the fact that inflation's coming down, those types of things, I think that is helping the dollar and in turn putting pressure on areas like materials and energy. Personal products leading the way in terms of industry group performance. This group jumped almost 4% on Monday. Big move, trying to take out the high that we saw back in December, doing it on an intraday basis, not quite able on a close though. So we'll want to watch, see if we get that breakout today. Semiconductors breaking out again. And look, they just broke out, and take a look at where the PPO is. Slight negative divergence. It happens almost every time. Look at this breakout back here in January. See how it broke out above the prior high? Look at where we were. We had a negative divergence. Just going to try and show it here. So here, you can see it almost every time. Here we make a breakout. PPO is right about here, negative divergence. But we kept going up and effectively took out the negative divergence. We pull back. We come back up. We break out. And where is the PPO? It's lower than where it was before, negative divergence. But what happens? We keep going up. PPO continues to rise, negative divergence gone. Pull back, PPO pulls back, we rally. We made a breakout yesterday. Look, negative divergence. It's now 3 times in a row. But when you look at the chart in hindsight, a technician will say we never had a negative divergence. We absolutely had one. It just got eliminated. And so that's why you can't jump at these divergences at the first sign, because many times that rally that creates the negative divergence isn't done. You've got to wait until you see the end of the rally, which normally comes with a reversing candle or something of that sort. That helps make it a lot easier to make a short-term topping call when you get a big reversing candle and a negative divergence. Haven't seen that yet. So you got to be careful about making those calls prematurely. Anyhow, then we got aluminum taking a big hit again. That was one of the reasons why materials went lower, although all industry groups in the material sector was lower yesterday. So it wasn't just aluminum, but aluminum was a big part of it with a big drop, almost 9% on the aluminum index yesterday. 10-year Treasury yield. Let's get a quick update here. And you can see quick rally back up. I mean, we're talking about definitely trendless action now in the 10-year Treasury yield. And the way I define trendless is when you see price action, or in this case, yield action, moving up or down below the moving averages, above, then below, then above, then below. That tells you you're in a trendless market. Because if you're trending up, you tend to trend above your moving averages. When you're trending down, you trend below your moving averages. When you're going sideways and you're not holding the moving averages as support, and they're not providing resistance, then you're in a trendless market. So effectively, I think these moving averages right now mean squat. They don't mean anything because we got no trend going. They're important support during an uptrend, and they're important resistance during a downtrend. But moving averages that are simply going sideways and price action, or in this case, as I said, yield action, moving up and down below, that's trendless. So look at the PPO. I mean, that again is a definition of trendless. We're sitting on the zero line. There's no momentum. So right now I'm waiting to see which way we break. We had a downtrend. Now we're in sideways consolidation. That's normally followed by a breakdown. Normally, anytime you have any kind of a pattern, consolidation pattern after a trend, you expect that consolidation period will be broken in the direction of the prior trend. So in this case, it was down. But it's not a guarantee. I'm not here saying we're going to go down to 350 in the yield. I don't know where we're going to go. Let's see where we break next. Break above 420, then I think at least in the short term, you got to say that the TNX bulls, if you will, have the upper hand. And you have to watch these moving averages as support. If they don't support, then that breakout was probably just a false breakout. To the downside, until we get down below about 378, 380, we're in a sideways consolidating period, which means anything goes within the range. So 3 days ago, before we got into the before we had the jobs report, you can see the market coming down, even with the jobs report, came down, and now, or actually went back up on Friday with the jobs report. But now it's back up above the moving averages and toward the upper end of the range. Let's see which way we break. There are, looking at economic reports, almost no economic reports out for the entire week. Today we have none. Yesterday we had the ISM services report out. That was that came in a little bit higher than expected, 53.4 versus 52.1. Wednesday, we've got nothing other than normal petroleum reports. Thursday, we got the jobless claims and wholesale inventories, and Friday we have nothing. I mean, so literally, this is the quiet period in terms of economic reports. Each month seems like we have 1 week that tends to be really quiet, and this is that week. Earnings, the number of large companies that most of us recognize, most of those are done reporting, but we do still have some that are reporting. It's just that the number of those big companies is going down, starting to go down, and that'll continue here over the next couple of weeks until we get to a point where pretty much everyone is reported. So I like to think of this week and next week as maybe like the tier 2 companies. Many of those companies, technology names that maybe aren't top tier. You know, we're not talking about Apple, Microsoft, and so forth, but they're still, you know, probably 50, 60, 80 billion dollar companies. They're not 3 trillion or 2 trillion. So they're still really good sized companies, and they can, you know, I think on the aggregate or in the aggregate, I think they can move the market, but usually one report here or there is not generally going to move the market. Anyway, that's where we stand as far as economic reports. So not a whole lot moving the bond market or the stock market in terms of economic reports. And so we're kind of focusing on these earnings reports now. S&P 500, you can see breaking out again on Monday, pulled back, or excuse me, on Friday, and then pulled back just a little bit yesterday. I still see the negative divergence. You can see that here. You got higher prices, still got this negative divergence, although it's starting to get far enough away where I'm about to maybe stop looking at it. I mean, if you think about how this PPO is calculated, it's a 12-day EMA versus a 26-day EMA. So you're only talking about going back 26 days, which is a little bit more than a month. It's about a little more than 5 weeks in you know, terms of trading days or trading weeks. So once you get past 5 weeks apart, you don't have any similar data. In other words, the data that created the PPO here that has no similar data over here. It's all new data. And you can see you kind of come down and then you start up again. I really think if we don't have some sort of a pullback in the near term, like within the next week, it's almost as though that negative divergence just kind of goes away just because of time. You know, looking back here in July, you can see we're right about at that 5-week mark when we got the bearish engulfing candle with that negative divergence, and then we went down, we reset the PPO. It actually turned into a correction, and you don't know when you top. Are you just going back maybe to the 50-day moving average, slight little pullback? Are you going to have a correction that maybe lasts a little longer, goes a little deeper? Or are you starting a bear market? I mean, all three of those can morph out of a negative divergence. So you got to look at your other signals. At least that's what I do to determine, okay, am I looking for, if it does pull back, what am I looking for? Based on my signals, if we pull back, I'm looking for short-term pullback. That's all. I would not look for a correction. I would definitely not be looking for a bear market. NASDAQ 100. NASDAQ 100 just making the breakout on Friday. And then, of course, yesterday just down a little bit. Very, very narrow kind of a day. So the trading range that we saw on Friday, see this big move? Yesterday was pretty narrow. Went down in the morning, came back up, and by around the noontime Eastern, maybe a little after, kind of just reached the level, and that's where we traded the rest of the afternoon. So there really wasn't a lot of volatility. And as a result, I know the VIX was down a little bit yesterday. I think it was down like 0.38 or something, maybe somewhere in the 13.5 range. But anyway, this move here on the NASDAQ 100 was very, very light in terms of volatility relative to what we've been seeing. And so, in fact, if I look back, I mean, I would say it's almost the least volatile day, maybe of 2024. Trying to looking at the highs and lows of each day. I mean, there just wasn't a whole lot going on there. IWM did make a little kick save at the 50-day moving average, but continues to trade weak on a relative basis. One thing I will point out, I don't know if this is a positive or a negative, but on a weekly chart, we are still trading above the 20-week. Actually, I know it's a bullish thing. The fact that we continue to trade above the 20-week, but when you look at the other major indices, they're well above the 20-week. So the IWM is the first one to come down, and we haven't quite tested the 20-week moving average, but we've gotten close. And if we do test the January low on the IWM, that will give us a 20-week test. 20-week moving average, 20-week moving average right now at 188.15. So if we go back to that daily chart, you can see here we went down to about 187.50 or so. So any kind of a pullback, further pullback to test that January low will at the same time be testing a pretty important 20-week moving average. So IWM, if we do see a shift, maybe some that negative divergence on the NASDAQ kicks in and we see some selling, I think one of the big things to look for on small caps is does that money move into small caps? In other words, do we start to see some outperformance? Because we have not been seeing it of late, certainly not in 2024. There are reasons why I think that money is going to rotate into the IWM, but I'll save that for a later time. Transports continue to sideways consolidate. We reached the high back in December, the low in January, which bounced off that key 15.2 level. And now we're just trading in the range. We went all the way back up near the top. We've now been moving back down, and we're simply going sideways here as the PPO struggles right around the center line. PPO is looking for direction. There is no momentum right now on this transport chart, and that's something that we need to see. All right, moving on to the chart of the day, I just want to mention to all of those of you that are new to the show, maybe new to earnings beats, or maybe some of you have been following for a while and just haven't taken the leap of faith. We do have a 30-day free trial to our paid service. We have a free download, by the way. If you haven't checked this out, you're definitely going to want to check this out. I follow history, and some of the information that we give you looking back over the last 70 years on the S&P 500 is pretty amazing. It is a free report to download it. I've put thousands of hours of research into studying the S&P 500 over the last 74 years. And some of the biggest history knowledge that you need to know is in this free report. I don't know why you wouldn't want it. So just take a few minutes, download it. It's a really nice PDF report. I think you'll enjoy it. But check that out for sure. And then we have a free newsletter. Free. No credit card required. You can unsubscribe at any time. You're not going to hurt my feelings. You need to check this out. And I'm going to talk about the chart of the day that we had for yesterday in just a couple minutes because it coincides with a member question. So I want to talk about that a little bit. Again, it relates to the chart of the day from yesterday. But if you looked at that and you decided you were an aggressive trader and you acted upon it, I think you'd be very happy this morning. Name, email address. That's all it takes. Monday, Wednesday, Friday newsletter. It's a very, very short read. 2 paragraphs in a chart is generally what you get. So our chart of the day today, of course, we don't publish one on Tuesdays and Thursdays, but we give you one here on the show, is Caterpillar. And I just wanted to point out a couple things with Caterpillar. First of all, They came out with their earnings yesterday morning. The market received them well. We had a gap up, but then we pulled back and printed a black candle on heavy volume. Now, if you're not familiar with the black candle, what it means is you are closing below the open. But the thing that distinguishes it from the red filled candle is that with a black filled candle, you still close above the prior day's close. So if you looked on Friday at Caterpillar, and let's get the numbers here. If you looked on Friday at the close, you don't pay attention to the market during the day. You look at on Friday at the close and you see a Caterpillar's at 315.09. And then you look at the close on Monday and you see Caterpillar's at 321.40, went up $6. And you own it, or maybe you're just watching it and you're like, okay, it's up $6. That's only part of the story when you start doing intraday analysis. This candlestick tells us that we actually gapped up all the way at the high of the day. The high of the day to the penny was at 9:30 a.m. 334.87. Whoever jumped in and said, hey, that's a great report, I'm going to buy it market open. That was not a good decision. And a lot of times when you do that along with others, the problem you face is that with a news announcement and a gap up, when you're buying, guess who's on the other side selling, providing the liquidity? Market makers. I can just tell you that if you're a short-term trader and you find yourself on the other side of market makers, you're probably going to be a very unsuccessful trader. So you want to be careful when these stocks gap up, because many do fill the gap, which means they just go down to the prior day's close. Caterpillar did this in one day. I mean, the low was 315.91. The prior day's close was 315.09. Basically, intraday, it went down and filled the gap within $1 after gapping up $19. So if you got in at the open, you were down $19 at some point during the day. Not a good feeling. Anyhow, off of an uptrend, when you get these can be reversing candles. Heavy volume, big gap up, and then failure. Black candle is a reversing candle off of an uptrend. It'll be interesting to see. Now, it may not mean it goes down today. It may not mean it goes down a lot, but I believe we're going to see lower lows before we see a breakout above 334.87. That's what that candle tells me. Now, again, it's no guarantee, but I think the odds would be in my favor to see a lower low before we get a breakout. Let's keep moving on. I want to talk about this chart of the day from yesterday and the question that came up. So I don't know where the question came from, and I'm paraphrasing here, but essentially the question that was asked is, Tom, you always talk about holding into earnings being the riskiest time, and not to hold stocks into earnings. So why would you suggest to do that? Or why would you, I'm trying to think of the name, or why would you recommend doing this? I'm pretty sure the word was recommend. Let me first just say, I don't recommend and I don't provide advice. I'm not a registered investment advisor. I'm not legally able to do those two things. I never recommend, I never provide advice. I provide education. I provide my opinion, but whether you buy or sell a stock is completely up to you. Number two, everybody has different risk tolerance. There are some who absolutely should not hold a stock into earnings. Folks who are really concerned about making sure they protect their capital. One of the biggest ways you can lose capital very quickly is holding into an earnings report gone sour. If management comes out and produces something the market's not expecting, you can see 5, 10, 20% hits or more with an earnings report. So if you're trying to protect your capital, holding a stock into earnings makes little sense, very little sense, because you're not in it. You're not willing to take that risk to the downside for that potential reward to the upside, because many stocks gap up 5, 10, 20% or more. We saw it last week. Meta, Amazon, two big ones that had big gap ups, kept going up. We've seen it before in other stocks like NVIDIA. If you miss their earnings, a lot of times you miss the biggest part of the moves to the upside. So you've got to look inside first and figure out what kind of trader you are and what kind of risk you're willing to take. Now, I pulled up this because I wanted to go in and look. I think on this don't ignore this chart, I talked about Google and the fact that its relative weakness was so obvious relative to its peers that there's no way I would hold this stock into earnings. And this was a earnings beats digest article, I believe on January, I don't know if I put it in here, nearly 2 weeks ago. I think it was January 26th or the 29th, Friday or Monday, that I wrote about this in EB Digest. And I said, I actually put these two support levels. We were up here somewhere. And I put these two support levels and I said, wouldn't be surprised to see Google trade in this range after earnings. And literally right after earnings, it fell right into that range. Now, I don't have a crystal ball, and it certainly was no guarantee, but it was an educated guess. First of all, when you look at relative strength, obviously Wall Street is not overly impressed with Google. You look at the price chart and you say, wow, this is a great looking chart, until you realize that relative to internet stocks, it's actually not that good. Internet stock chart or internet chart looks better. If you look at the industry group, it looks better than Google. So rather than Google leading the industry group, it was the industry group that was dragging Google to the upside. That's a big difference. That's relative strength versus relative weakness. And what we saw was relative weakness going into the report. Google actually posted decent numbers. I think they beat top and bottom line. Pretty sure they beat bottom. And I think they beat top. But market didn't care. Market went, we saw it go down. 139 to 144 was the trading range, and we went right in. So at the end of this, I had said I'll be featuring a stock that is setting up potentially for a big move higher, at least based on the way it's been trading. And then if you registered, you would have found that I was looking at a software stock, Varonis Software, Varonis Networks, or VRNS. And that stock was one that I thought looked pretty good going into its earnings report. First of all, look at the volume over the last 3 months when it made this big push to the upside. Huge volume, big move up. It also was a leader in software. And then over the last 6 weeks or so, it's just been consolidating. Just kind of, everybody seemed to be getting in during this move to the upside. Buy on rumor. That's what I'm seeing here. Sideways consolidation, kind of, fell out of the limelight for a little bit. And I thought, this is a company that I think could have a really good earnings report. And so that's why the question came in. Why would I suggest a company right before its earnings report? Well, number one, if you're an aggressive trader, something like this, there are a lot of traders who really like to get that blood pumping. They like being in on earnings reports. They'll take that risk to the downside. Maybe they're younger, maybe they're older and just have a bigger portfolio. But for whatever reason, they feel like, hey, if I can, get more than my fair share to go right versus wrong, then I'm willing to take that risk to the downside in order to capture the upside return. And so to the member that asked the question, yes, it is I think it is the absolute most volatile day. It's an opportunity for you to lose a lot of money or possibly make a lot of money, literally at the time the report comes out. I know last night after Varonis Systems reported, the price was at 50. It went from 45.54. I saw it in after hours. It was as high as 50. I think this morning when I looked, it was around 49. Now I haven't updated. We did just open. So I thought we would close out today by taking a look at two things. First, let's check out and see where we are on Varonis. Well, it opened at 50.14, got down as low as 47.41, and right now is at 48.79. So I would say that if you went into this report believing that you're going to get a move to the upside and you bought it, well, guess what? If you sold it at the opening bell, we don't know where it's going to go after the opening bell. It could fill the gap. It could take off. I think at this point, it really is a 50-50 shot. But I think that strong relative strength gave us an opportunity, if we were willing to take the risk, to potentially earn a nice chunk of change. And so here it opens at 50.14, which from yesterday's close, 45.54. That's $4.60. That's a 10% gain at the open. like that, if you're willing to take the risk. Not all trades work out this way. Sometimes they look great in terms of relative strength, and we get a sell on the news. It happens. But I do think that this gives you better odds. I don't know what those odds are. I think it's better than 50-50. Is it 55-45, 60-40? I don't know, but I think it gives you better chance. So if you sat down, if you've ever been out to Vegas, you know that when you sit down at Vegas, you really have the odds stacked against you. I mean, there's a couple of different bets in Vegas where maybe you can get like even odds with Vegas, but that's about it. I'm saying or suggesting, and I haven't done a study, I'd have to do a study, but I'm suggesting that the odds here are better than 50-50. So you might think that this is a gamble, and it is. Like I said, new fundamental news is coming out. We've gone through a quiet period, so nobody's supposed to be talking about these results. And so on the surface, it does look like it's a 50-50 proposition. But I think if you look at relative strength and you check out what Wall Street thinks of the company, which is if the company's outperforming, chances are you've got institutions that have been accumulating. Whereas if you're underperforming, probably you're seeing distribution. We're seeing, Wall Street move away from those companies into other companies within that space. So yes, it's risky, and this one happened to turn out. It just comes down to what kind of risk you're willing to take. The other thing I wanted to show you was we do this upcoming earnings chart list. So every company that reported after the bell yesterday and before the bell today, we have a chart list for it at Earnings Beats. All of our members, and even I believe our Earnings Beats Digest members, can click on a link and can pull this up for free. So again, becoming a free EB Digest member, it's just a gift that keeps on giving in terms of being able to get these chart lists. But if you put this chart list in summary form, we are now 8 minutes into the market open. I can look and see exactly which companies are looking awesome. Palantir, this is one of our portfolio stocks. So we're getting a huge lift again from one of our portfolio stocks, which is awesome. Up 20%. Here's Varonis right here. It's number 6 on the list, up 8.59% right now. And then you can hit this change button, go right back down to the bottom, which ones maybe aren't looking so good. Fabrinet or Fabrinet, FN down 22%. Rambus, unfortunately, that's another one of our portfolio stocks. So this one's hurting us, pretty much just offsetting Palantir right now. But this is one that over the last 3 months has started to lose some relative strength against that semi group. And now we're probably seeing why. I have not seen the report on any of these stocks. I haven't looked at Palantir. I haven't looked at Rambus. I didn't look at Varonis. I'll be doing that later in the week. But anyway, just wanted to point out this is a great tool to have to be able to just pull up every single company that reported since yesterday at the close and take a look at what they're doing, at one moment in time. I used to have my list of companies reporting, and I'd look at them one at a time. Boom, boom, boom. And once I started using Stockcharts and I, was able to put these earnings into a chart list, I mean, this is a great feature just to have all of these companies in one spot to see what's happening. I mean, we could pull all these up into an RRG chart. We could look at it candle glance, taking a look here. So we could just look at them all real quick on the chart. What have they been doing before earnings? What are they doing now? That sort of thing. A lot of different ways you can look at this, but anyhow, and I think if I pull it up right here, RRG. So here are all the RRGs. So the top one, KKR, if I click on that, this is what KKR looks like right now. And then we can kind of see how KKR has been rotating in terms of performance relative. The benchmark's the S&P 500, by the way. Anyway, a lot of different things you can do with it. It's pretty cool. But we do need to wrap up. Let me take a quick look at what the market's doing. We got the Dow up 120, S&P 500 up 11, NASDAQ up 29, small caps up on a percentage basis, actually keeping up. Mid caps actually have the highest percentage right now among those I just talked about. And then you can see the VIX dropping back down again, 13.44%, down another 23. The VIX, I'm telling you, anytime it's below that 17 level, the stock market goes higher. I pointed out recently that the VIX had gone up over a period of about 2 months. And while the VIX went up over 2 months, it was down around 12 at the end of November. And now, recently got up over 14. During those 2 months, while it went to 12 to 14, I think probably most people would have thought the S&P 500 went down because the VIX went up. Well, it doesn't work that way. The VIX can go up from its recent lows, and the S&P can keep going higher. And in fact, usually does. And that's what we've seen here. The S&P 500 just keeps going up. 49, 53, 52 now. We're only 50 points, 48 points away from that psychological 5,000 level. Anyway, went a little bit over today, but just wanted to go over a few things here. Really appreciate you tuning in. Please take us up on our free offer, the free EB Digest. Why not? The free download on the history of the S&P 500. Why not? And I would even say take out a 30-day trial here at Earnings Beat. You're going to find out that we provide a lot of great information to our members to help you navigate the stock market. We provide guidance. We provide education. We provide research that I believe is unparalleled. I'm a little biased, but I also really do think it's unparalleled. Check it out. You get a 30-day free trial. You do have to give a credit card for a full service, but we'll remind you at the end of the 30 days to make sure you want to keep your membership going. Anyhow, that's it. Have a great day, everybody. I'll be back tomorrow morning for your next Trading Places Live. Happy trading.